Hello everyone. Today we will continue to learn analysis of profit and loss statement. The expense details. In the previous video, we had learned about the revenues a company generates. Moving further on the P&L statement, in this video, we will look at the expense side of the profit and loss statement along with the associated notes. Expenses are generally classified according to their function, which is also called the cost of sales method or based on the nature of expense. An analysis of the expenses must be shown in the profit and loss statement or in the notes. As you can see in the extract on screen, almost all the lines items have a note associated to it. The first line item on the expense side is cost of materials consumed. This is invariably the cost of raw material that the company requires to manufacture finished goods. As you can see, the cost of raw material consumed or raw material is largest expense incurred by the company. This expense stands at 2101 crore rupees for the FY14 and 1760 crore rupees for the FY13. Note number 19 gives the associated details for this expense. Let us inspect the same. As you can see, Note 19 gives us the details of the material consumed. The company uses lead alloys, separators and other items, all of which adds up to 2101 crores. The next two line items talks about purchases of stock in trade and change in inventories of finished goods, work in process and stock in trade. Both these line items are associated with the same note. Purchases of stock in trade refers to all the purchases of finished goods that the company buys towards conducting its business. This stands at 211 crore rupees. I'll give you more clarity on this line item shortly. Change in inventory of finished goods refers to the cost of manufacturing incurred by the company in the past, but the goods manufactured in the past were sold in the present or current financial year. This stands at 29.2 crore rupees for the FY14. A negative number indicates that the company produced more batteries in the FY14 than it managed to sell. To give a sense of proportion in terms of sale and cost of sales, the company deducts the cost incurred in manufacturing the extra goods from the current year cost. The company will add this cost when they manage to sell these extra products sometime in future. This cost, which the company adds back later, will be included in the purchase of stock in trade. Here is an extract of note 20 which details the above two line items. The details mentioned on the above extract are quite straightforward and easy to understand. At this stage, it may not be necessary to dig deeper into this note. It is good to know where the grand total lies. The next line item on the expense side is employee benefit expense. This is quite intuitive as it includes expense incurred in terms of the salaries paid, contribution towards provident fund and other employee welfare expenses. This stands at 158 crore rupees for the FY14. Have a look at the extract of note 21 which details the employee benefit expenses. Here is something for you to think about. A company generating 3,482 crore rupees is spending only 158 crores or just 4.5% of its sales on its employees. In fact, this is the pattern across most of companies, at least non-IT companies. Perhaps it is time for you to rethink about the entrepreneurial dream you may have nurtured. The next line item is finance cost or finance charges or borrowing cost. Finance cost is interest cost and other cost that an entity pays when it borrows funds. The interest is paid to the lenders of the company. The lenders could be banks or private lenders. Company's finance cost stands at 0.7 crores for the FY14. We will discuss more about the debt and related matters when we take up the video on balance sheet later. Following the finance cost, the next line item is depreciation and amortization cost, which stand at 64.5 crores. To understand depreciation and amortization, we need to understand the concept of tangible and intangible assets. A tangible asset is one which has a physical form and provides an economic value to the company. For example, laptop, printer, car, plants and machineries, buildings, etc. An intangible asset is something that does not have a physical form but still provides an economic value to the company, such as brand value, trademarks, copyrights, patents, franchises, customer lists, etc. An asset has to be depreciated over its useful life. Useful life is defined as the period during which the asset can provide economic benefit to the company. As an analyst, how do we get a sense of the cash movement? Well, the cash movement is captured in the cash flow statement, which we will understand in the later videos. The last line item on the expense side is other expenses. At Rs 434.6 crores, this is a huge amount classified under other expenses, hence it deserves a detailed inspection. From the note, it is quite clear that other expenses include manufacturing, selling, administrative and other expenses. The details are mentioned in the note. For example, Amar Raja Batteries Limited spent 27.5 crores on advertisement and promotional activities. Adding up all the expenses mentioned in the expense side of P&L, it seems that Amar Raja Batteries has spent Rs 2941.6 crore rupees. The profit before tax. It refers to the net operating income after deducting operating expenses but before deducting taxes and interest. Proceeding further on the P&L statement, we can see that ARBL has mentioned their profit before tax and exceptional item numbers. Simply put, the profit before tax is equal to total revenues minus total operating expenses, that is 3482 minus 2941.6 is equal to 540.5. However, there seems to be an exceptional item or extraordinary items of Rs 3.8 crore rupees, which needs to be deducted. Exceptional items or extraordinary items are expenses occurring at one odd time for the company, and the company does not foresee these as recurring expense. Hence, they are treated separately on the P&L statement. Hence, profit before tax and extraordinary items will be 540.5 minus 3.88 is equal to 536.6 crore rupees. This is a snapshot of profit before tax of ARBL. Net profit after tax. The net operating profit after tax is defined as the company's operating profit after deducting its tax liability. We are now looking into the last part of the P&L statement, which is the profit after tax. This is also called the bottom line of the P&L statement. As you can see from the snapshot above, to arrive at the profit after tax, we need to deduct all applicable tax expenses from the PBT. Current tax is corporate tax applicable for the given year. This stands at 158 crore rupees. Besides this, there are other taxes that the company has paid. All taxes together total up to 169.21 crores. Deducting the tax amount from PBT of Rs 536.6 gives us the profit after tax at 367.4 crore rupees. Hence, net PAT is equal to PBT minus applicable taxes. The last line in the P&L statement talks about basic and diluted earnings per share. The EPS is one of the most frequently used statistics in financial analysis. EPS also serves as a means to assess the stewardship and management role performed by the company directors and managers. The earning per share EPS is very sacred number which indicates how much the company is earning per face value of the ordinary share. It appears that ARBL is earning Rs 21.51 per share. The detailed calculation is as shown below. The company indicates that there are 17 crore 8,12,500 shares outstanding in the market. Dividing the total profit after tax number by the outstanding number of shares, we can arrive the earnings per share number. Now that we have gone through all the line items in the P&L statement, let us relook at it fully. Hopefully, the statement above should look more meaningful to you by now. Remember, almost all line items in the P&L statement will have an associated note. You can always look into the notes to seek greater clarity. Also, at this stage, we have just understood how to read the P&L statement, but we still need to analyze what the numbers mean. We will do this when we take up the financial ratios. Also, the P&L statement is very closely connected with the other two financial statements, that is, balance sheet and the cash flow statement. We will explore these connections at a later stages. Thank you for watching this video. Please do like, comment, share and subscribe this YouTube channel.